E-Mini refers to electronically traded futures contracts that are smaller in size compared to standard futures contracts. These contracts are traded on electronic trading platforms and provide investors with exposure to a variety of financial markets, including stock indices, commodities, and currencies, without the need for physical delivery of the underlying asset. Key points about E-Mini contracts include: 1. Size. E-Mini contracts are smaller in size than standard futures contracts, making them more accessible to individual investors and traders with smaller capital. They typically represent a fraction of the value of the corresponding standard contract. For example, the E-Mini S&P 500 futures contract represents 1/5 the value of the standard S&P 500 futures contract. 2. Electronic trading. E-Mini contracts are traded exclusively on electronic trading platforms, such as the Chicago Mercantile Exchange's CME Globex platform. This allows for faster execution of trades, increased transparency, and greater accessibility to a global audience of traders. 3. Liquidity. E-Mini contracts tend to be highly liquid, with active trading volume and tight bid-ask spreads. This liquidity provides investors with the ability to enter and exit positions easily, even in volatile market conditions. For diversification, E-Mini contracts cover a wide range of asset classes, including stock indices like the S&P 500, NASDAQ 100, and Dow Jones Industrial Average, as well as commodities like gold, crude oil, and natural gas. This allows investors to diversify their portfolios and hedge against specific market risks. 5. Speculation and hedging. E-Mini contracts are used by both speculators and hedgers to manage risk and profit from price movements in the underlying markets. Speculators aim to profit from short-term price fluctuations, while hedgers use futures contracts to protect against adverse price movements in their portfolios. 6. Margin requirements. Like standard futures contracts, trading E-Mini contracts requires investors to post an initial margin deposit, which serves as collateral for the position. Maintenance margin requirements must also be maintained to keep the position open. The lower contract size of E-Mini contracts results in lower margin requirements compared to standard contracts. 7. Settlement. E-Mini contracts are settled daily based on the difference between the contract price at the time of entry and the settlement price at the end of the trading day. This settlement process eliminates the need for physical delivery of the underlying asset and allows investors to realize gains or losses on their positions without taking delivery. Overall, E-Mini contracts provide investors with a convenient and efficient way to gain exposure to various financial markets, offering liquidity, diversification, and flexibility in trading strategies. However, like all derivative products, trading E-Mini contracts involves risks and requires a thorough understanding of the underlying markets and trading mechanics. Investors should carefully consider their risk tolerance and investment objectives before trading E-Mini contracts.